likely to happen. And as you said, $85 billion in cuts. Importantly, that's through the end of September. It's not throughout the calendar year because the fiscal year ends in September. So it's a lot of spending cuts in a short period of time. It's deemed to be beneficial to the bond market because it'll hurt the economy to the tune of a few $1 billion a week. And that's, of course, not what the economy needs right now. It's barely making it, so to speak, growing at a 2% pace versus usual 3%. So Treasury yields might be pressured lower in this case because equity prices likely would be pressured lower as a result of this. It's policy uncertainty more generally that's hurting the economy, and it keeps holding it back, and that's helping the bond market.
Do you think we're going to get any clarification when we hear from Ben Bernanke?
Ben Bernanke speaks on Tuesday and Wednesday, first to the Senate, then to the House. It's his semi-annual monetary policy report to Congress that he's required to do under law. We'll get a little more clarity about his bond buying intentions. The Fed is purchasing $85 billion a month in securities, and by coincidence, the same amount as the sequester. So 1 month's buying will take care of that sequester, finance it, if you will. We would look for clarity on how many more months he might be intending to buy bonds, because there are some indications lately that the Fed might want to taper the program off because its so-called balance sheet is growing larger and the risks are growing, and maybe the economy will pick up in the second quarter, even depending on the sequestration because of the housing market. But we'll see. So we want more clarity on bond buying as the main story.
And in terms of your investment strategy and where you're thinking, you like the mid part of the curve last time we spoke. You still like that, right?
Yeah, PIMCO is investing in the 7-year point on the curve. A 7-year becomes a 6-year in a year. It rolls down the curve. 6-year yields less. So in other words, as the yield drops, as it will, the price will rise, and you can get an extra percentage point in total return in a year by investing in that point. But one bigger point to make on this is we've been avoiding longer dated maturities. And if one looks at the longest bond future, so-called ultra bond, since July it's fallen 20 price points at a starting point of 177. But that's a big drop. So by avoiding those issues, bond investors have, like PIMCO, have avoided pain. So we'd avoid issues beyond 10 years maturity. You want to stay as close as you can, but not too close to where the Fed's protecting markets. If you go too close in the curve, you won't get much yield or even protection against macro risks.
And you still like housing?
We do. First time in 7 years betting on recovery, and we're doing it through the physical markets, and secondly in the non-agency mortgage-backed securities, and third in credits that relate to housing. Just think of a home and lumber and cable and appliance manufacturers and mortgage insurers and mortgage originators and title insurers. It's a way to beat the rising rate climate, if there is one, because these credits probably would fare better in a case where housing prices are rising. We expect them to rise a little more than the CPI this year, 4.5%, let's say. That's a lot more, actually. And a little more than the CPI next year, 2014, and around the CPI in the 3 years subsequent to that. So a good story because of the underbuilding of homes relative to the population growth. And one final point, immigration reform, if it happens, will be important to population growth and housing. 30% of all population growth is due to immigration, and 66% of naturalized, formerly non-citizens, own homes. And so once a person becomes a citizen, they're more likely to own a home than if they're not, because that figures in the 30% range for non-citizens.
I want to move away from government-backed issues for just a moment and talk about the high-yield market. You've got some concerns about frothiness there, if you will. But default rates are predicted to be low, so why are we worrying about that?
PIMCO expects a default rate of only 2 to 3%. Historical norm is in the 4 range. A lot of companies decided in the last few years, hey, we don't want to have too much of this short-term debt. The yields are high. Let's refinance. There's been massive refinancing. So there isn't a lot maturing this year, next year, or the year after. The wall's been pushed way out, even to 2016. So there can't be a lot that defaults because there's not a lot maturing. The worry is that there'll be mark-to-market losses, that prices could fall, yields widen relative to treasuries because of uncertainties of various sorts, whether it be Europe or U.S. policy uncertainty. But the way to play lower grade securities is probably, as PIMCO thinks, in loan securities. They're also double B/B rated, generally speaking. They yield 1 point less, let's say 5% instead of 6% for the high yields universe. But the recovery rate's been running about 80% for bonds that have trouble versus 40% for high yield, and so you're safer there. And finally, Loan securities, they vary, and they will move with interest rates. As they go up, you benefit actually in a loan security, whereas in other types of securities you might not.